Riggs in New York, in for Emily Chang. This is Bloomberg Technology. Coming up in the next hour, has a technology Cold War already begun? President Trump says Huawei may be part of the trade deal, shifting from previous efforts to portray the U.S. campaign against the company as a separate issue during the ongoing trade dispute. Plus, Tesla's wild week, the electric car maker continues to get pummeled by the bears, with shares falling nearly 10% in the last 5 sessions. Can the company weather the storm? And our exclusive conversation with the former Apple executive Angela Ahrendts, and we'll cover how she transformed Apple into a retail powerhouse. But first, to our top story of the week, and it is all about Huawei. On Thursday, President Donald Trump said the Chinese tech giant could be part of a trade pact with the country. The Trump administration is seeking to choke off Huawei by limiting the sale of vital U.S. components to Chinese telecommunications equipment maker over security concerns. The U.S. had held off from blacklisting Huawei out of concerns the move could disrupt trade negotiations with China, and only really took action after the last round of trade talks hit an impasse. Joining us to discuss Techonomy founder David Kirkpatrick. Also with us, Bloomberg Technologies' Alistair Barr. Alistair, I want to start with you quickly, sort of just recap the week for us. We sit here, we know it was a week ago really when we first started to hear conversations about Huawei being blacklisted. It has been a long week, hasn't it?
It certainly has. I would say the week in one phrase is that the global technology supply chain is fraying seriously. This is a supply chain that's been built up over 10 to 20 years, and it will take a very long time to rebuild if this Huawei problem expands to sweep up a lot of US and other tech companies around the world.
David, I want to bring you in here because we talk about this global supply chain. You've been covering the tech sector for years and years. Is it possible, given how integrated we are, to sort of disconnect now the global supply chain?
Absolutely not. You can't really separate the U.S., the Chinese, the European, the global technology supply chain. We really are operating in a global supply chain economy, a global economic system in general, which is why I think this whole really irrational battle that's emerged between the U.S. and China is almost implicitly and intrinsically destructive to all the parties concerned.
Alistair, I also want to talk about some of the ripple effects that we're seeing, and particularly as we talk about the supply chain, some of the other chip makers. Have we heard from them really in the last week or so about what they're saying about how this really could impact their business?
So companies like Qualcomm, Xilinx, Broadcom, these are really big, Intel even as well, really big US chip makers. They've told employees that they are not supplying Huawei with components for the time being. This is to comply with President Trump's order. And, you know, Huawei is a huge customer for these companies. And so it has been a big blow, and those shares have fallen a lot. A lot of other US tech companies are also trying to comply, but in some cases, it's not particularly clear exactly what they should and shouldn't do.
David, is this the right approach? I mean, so often when we talk about Huawei and trade and sort of the approach that the current administration is taking with China, would you argue that this is the wrong way to go?
Well, I don't think that pushing back against Huawei for what in many ways are some good legitimate reasons should be tied into a larger trade battle, first of all. I also, even if you do believe, as to some extent I do, that Huawei needs to have a little bit of religion taught to it, the way to do it is much more thoughtfully and carefully than this administration has done. I don't think that the Trump administration's approach recognizes the degree to which these supply chains are integrated. You know, when we saw Xi Jinping this week imply that he might really, by going to a rare earths supply company, which is a key component for chips all over the world that's mostly sourced in China, and implying that somehow China might hold back that kind of material from the rest of the world, that just goes to show how upsetting this battle could become, because honestly, almost every chip maker in the world and many, almost really everybody who makes anything from technology could ultimately be affected if China were to pull that kind of nuclear option. Now, I'm not sure they would. I think they probably wouldn't. But we are in a place where that is not inconceivable. It's terribly scary, and it's unnecessary.
Alistair, as we push this story forward and think to where we might be in the next coming weeks and months, what are you hearing from companies on if there is a retaliation from China? What if they blacklist some of our American companies? Who would be hurt? And really, is that a possibility at this point?
The big question mark for us this week when we've been thinking about it is Apple. So actually, Apple epitomizes this whole situation really, really well. So the theory with Apple and the concern is that China would somehow promote an unofficial boycott of US technology products, including the iPhone. They might also encourage Chinese consumers to buy Huawei products rather than iPhones, for instance, and that could have a big impact on Apple. But then, if you also have to look at it from the other perspective, which is that the assembly of an iPhone supports about 1.4 million jobs in China directly, and a lot of other jobs in China too. So it remains to be seen whether China would be willing to take that type of impact.
I mean, David, you've been nodding your head as we sit here, particularly in your research when you've been covering big tech. A lot of it is Apple, companies that get 17-20% of their revenue from China. How concerned should they be at this point?
They should be concerned, and their investors should be concerned, but Apple's very structure is a good illustration of the intertwined nature of the global supply chain. It says designed in California, made in China, but in fact, the physical pieces go back and forth. China's overwhelmingly where Apple makes its product, final assembly of all of its products. 17% of its revenues roughly come from there now. So it could be, as Alistair suggests, that they might sort of either officially or unofficially deter purchase of Apple products in China. I don't think the Chinese government would take the chance of really pushing back on the assembly of Apple products there because of, as he said, the huge jobs impact that would cause. They have enough problem keeping their people employed as it is.
Well, a story that is developing. So thank you, Alistair Barr of Bloomberg Technology. And of course, David Kirkpatrick, Techonomy founder. You will be sticking with me. And as a reminder, tune in on Bloomberg TV on Monday for our exclusive interview with Huawei's founder and CEO from the company's headquarters in Shenzhen. Now, SpaceX has launched a huge payload to create an orbiting network providing broadband internet around the globe. The Falcon 9 rocket blasted off from Cape Canaveral carrying 60 satellites on Thursday night. After the launch, SpaceX also disclosed it raised more than $1 billion in equity offerings in the last few months. And coming up, it is a rocky week for Tesla. It continues with the stock down now at its lowest point since 2016. We'll discuss analysts' biggest concerns about the car maker next. This is Bloomberg. Tesla has taken a big blow from Wall Street this week. The car maker stock has fallen dramatically. It's now down to its lowest level in more than 2 years amid growing analyst concern. Wedbush analyst Dan Ives said it faced a code red situation and explained to Bloomberg his biggest concerns for the car maker.
Chance me playing in the NBA than them hitting those numbers, this quarter. And I think fundamentally, the problem just comes down to what we're seeing in the U.S. in terms of demand, and especially in Europe and China.
Meanwhile, Bloomberg also spoke with Loop Ventures co-founder G. Munster, who was a bit more optimistic.
I am a believer in Tesla. I think that they will, in fact, turn the corner and capture what will be a juicy growth curve around electrification of vehicles. We're at 1 or 2% today globally. Eventually, that's going to be 100%. But 2019 is going to be a difficult year. The demand question is quite critical.
And Bloomberg's Ed Hammond sat down with Bailey Gifford, CEO of Andrew Tefler, whose firm is the largest outside shareholder in Tesla. He discussed the firm's investment strategy and conviction towards the company. Take a listen.
We try to engage with companies generally behind closed doors. We've generally find that that's more effective. Much of the time we're spending is trying to encourage companies to reinvest in their business and take a longer term view. They come under a lot of pressure from other shareholders to take a short term view and to try and sometimes to give up good opportunities, because in the short term that will reduce their earnings and potentially make their share price vulnerable. But we believe that if it's a long term positive, they should do it, and we were trying to support them and try to change the dialogue.
But why not publicly? Because so many shareholders are now being more vocal. Even small shareholders are being much more willing to come out and say, we want to see this and this done.
Yeah. No, in certain cases we will do, but only if we're failing to have the impact that we want behind closed doors.
Now, one company that is especially high profile at the moment, this week obviously has been on something of a roller coaster, is Tesla, where we've had fairly extreme things be published. Some of the analysts saying it could potentially go as low as $10. Company, after Elon Musk, barely give it as the largest investor. What is it about that company that remains so attractive?
Sure. Now, we need to remember, I'm an engineer by training, and the engineering that they've managed to achieve there is transformational for not just for that industry, but for the world in general. And that they've achieved a lot. Scaling up is difficult, really difficult, and they're working their way through that just now. And we're trying to be supportive shareholders to help them in that journey.
And how do you do that? How do you support the company to make sure that the story is the engineering story versus the other story, which has been much more dominant? Yeah.
No, it's trying to be supportive with management, with the board, trying to encourage them to do exactly as you're saying.
That was Bailey Gifford CEO Andrew Gifford. And for more on Tesla, I'd like to bring in Bloomberg's Max Chafkin and Techonomy founder David Kirkpatrick, who is still sticking with me. Max, I want to start with you. We heard it there. I mean, tons of bears, some bulls, but really sentiment this week to me felt like it was turning a bit more bearish from the street. Wrap up for me here, sort of what happened.
Yeah, so well, what happened is that the main thing is that the China trade war is obviously not going to get settled anytime soon. That is bad for Tesla. Tesla really needs to sell some cars in China. The other thing that happened is that Elon Musk sent an email to his staff talking about hardcore cost cutting. Now, on some level, that's good if you're an investor, because you don't want your company wasting money. But Tesla is supposed to be a growth story. It's supposed to be, marching towards taking over the entire automotive industry, reshaping transportation. And it's hard to do that when you are radically cutting costs. Right. And that kind of puts the whole thing, into question for some investors, because the question becomes, is this a growth story, or is it kind of like a mid-sized car company that really isn't going anywhere, and that's where the bears are landing?
Well, David, talk to me about some of those bears, because you write in your note it's really hard right now not to be bearish on Tesla. What's the downside scenario here? Well,
the downside scenario, as Max says, is that they will never really be able to be the major central player in electric vehicles and autonomous vehicles, in fact, that they have promised to be, partly because every other major car maker now sees the potential in those markets and is working very methodically to compete head-to-head with Tesla. But they are ahead in a number of key technologies, even still, as one of the analysts you just quoted before suggested. So I don't think they're out of the game at all. I think it's always been a company that was more a sentiment story than a strong, hardcore financial analysis story. It's are you a believer or are you not a believer? And even more than a believer in Tesla is, are you a believer in Elon Musk? And he still has a sort of zealot class of people that will continue to support him, I believe. But, they've got to figure out a way to make money and settle down a little bit before any of us are really going to be comfortable about their long term.
Well, I'm going to try to surprise you here and say we are going to try to do some hardcore financial analysis on this show. And one of those things has to be about China. Basically, at the end of the day, it's supply and demand. And you heard Max earlier talk about how perhaps some of the trade fight is weighing on them, as they do need to be in the Chinese market to meet demand. What's the risk that trade sort of blows this up?
Well, they are yet another American, in effect, tech company that depends very much on China for their success as a business. I would actually go to even a bigger point. I think the Uber IPO and its failures and the attention that it has put on the whole notion of chronic money-losing businesses that you just cross your fingers are going to be giant Amazon, Facebook-like colossi down the road is being put into question, and Tesla has been a company for its entire life that people have pretty much had in that category. Someday it's going to dominate, not today, but therefore I'll buy its bonds, I'll buy its stocks because I believe in that long-term story. And, you know, China's a potential negative, but just general execution seems to be a serious negative.
Well, along that with general execution, Max, it's been about production and deliveries, and you had a lot of analysts wonder if they were going to miss those targets that they'd set from themselves, even though Elon Musk in his email said we're ahead. This week, he said we're going to meet the targets. From your reporting, do we look like we're on track to meet those targets?
Yeah, it's really hard to say, particularly because Tesla has shown this tendency to kind of try to Elon Musk, it feels like, is watching the stock market. And so again, it's hard to know whether that email was leaked strategically or whether that was, whether what we're seeing was a genuine leak or something like that. So it's anybody's guess. I mean, it's a good sign that Elon Musk is sending an email to employees, saying that production is on track. Just stepping back, what I would say is that some of this sort of sense of hitting the wall was I think, inevitable. Elon Musk has been this magician saying, I am going to make a $35,000 electric car, and the argument has been, can he do it, can't he do it, and that's where the bulls and the bears are. And once he makes the $35,000 car appear, it's hard to know what the magician's next trick is. And we've seen him do a bunch of different things. We've seen him talk about China, but then there's the trade war. We saw him talk about autonomy, but then there's another HTS, a government investigation into a fatal crash. So it's kind of like the company is grasping for its next act, and no one quite knows what that would be.
Okay, well, thank you both. That was Bloomberg's Max Chafkin and Techonomy founder David Kirkpatrick. You will be sticking with me. And coming up, after 15 years on the private market, Peter Thiel's Palantir is getting closer to an IPO. But will investors stick around if the offering gets delayed? We'll discuss next. This is Bloomberg. As services like Uber and Lyft explode across the globe, drivers are ditching their cars in favor of ride-hailing services. But as owning a car becomes less of a priority, where do self-driving cars fit in? Bloomberg Quick Take explains the rise of mobility as a service.
Thanks to the smartphone, going from A to B is so easy that it's got some urban dwellers wondering, why bother owning a car when you can easily get where you want at the press of a button? It's an idea known as mobility as a service, where travellers say goodbye to their own cars and sign up instead for transportation on demand, booked through their smartphones. Imagine, for instance, a commuting plan that charges by the mile or through a monthly fee, like Netflix. The demise of car ownership, at least in the world's growing urban centres, is a prospect that the world's automakers are getting ready for. But it's not going to happen right away. A major switch to subscription transportation requires two things to fall into place. The first is already well underway: the explosion of ride-hailing apps like Lyft, Grab, and Careem. The second part isn't quite there yet. That's driverless cars. Removing the human from behind the wheel slashes the cost of a taxi ride. That'll make mobility as a service so cheap in many places, it won't make financial sense to own a car anymore. A typical ride today costs $2 to $3 a mile, but a robotaxi is projected to cost as little as 70 cents per mile. Tesla chief executive Elon Musk reckons he can lower that to 18 cents a mile. That will turbocharge demand for mobility as a service, which is destined to become a $10 trillion business, according to Ford Motor Company. That's why tech giants like Google and Apple are developing their own self-driving systems to take on the world's leading automakers, including Volkswagen, General Motors, Ford, and Toyota. Eventually, a single smartphone app could connect us to a web of options: robo-taxis, self-driving shuttles, subways, e-bikes, and electric scooters that'll whisk us through congested megacities, where 2/3 of the global population is projected to live by mid-century. Someday, urban dwellers may have to spend a day in the country to catch a glimpse of that 20th century show pony known as a private car.
Palantir's hotly anticipated IPO may be delayed. While the secretive data mining company said it could go public in the second half of 2019, sources told Bloomberg this now seems unlikely. Issues ranging from Palantir's board to its sales team may be standing in the way. Joining us to discuss is Bloomberg's Lizette Chapman. Lizette, frankly put, why the delay?
Well, there are three main reasons that our sources have been telling us. The first one, mainly their board. It is too small and it's not independent. It has 4 board members, which is about 1/3 of the typical size to 1/2 of the typical size of a public board. 3 of those are co-founders, and just 1 could be considered independent. Now, both major stock exchanges require majority of board members to be independent. They don't have that. The second issue is the fact that their sales team is still developing, and this is something that they've only really added during the past year. So they want to see what else they can do in terms of maturing that and increasing sales. They want 2 years of really strong consecutive sales growth, which is something that our sources have told us they're on track to do by the end of this year. The third thing is that they really need to mature their finance team, and they are looking to add more seasoned finance professionals.
Well, Lizette, talk to me about the finances a little bit. Usually when you IPO, it's to raise money so investors can cash out, or because you need to raise money because you need it. But they don't actually need the money, do they?
No, they don't. At least that's what our sources are telling us right now. And based on how they've operated in the past, again, this is a very long-standing, well-financed company. It's been around 15 years. It's raised more than $2 billion so far. Last year, increased sales about 40% to nearly $1 billion, and it narrowed its loss to just $30 million. So it's just on the cusp of break even. They're not a big acquirer of other technologies, so that's another reason why they don't need to go public. They simply don't need that currency. And their investors so far, which include Peter Thiel, who is one of the co-founders, he's the chairman, and he's also one of the largest investors. He's not exactly poor, and he hasn't shown any impatience in its public debut.
Well, great reporting. That was Bloomberg's Lizette Chapman. Thanks for joining me. And coming up, our exclusive conversation with Angela Ahrendts, former Apple Senior VP of Retail, looking back at her legacy in the company and her thoughts on the current direction it is taking. We'll have more next. This is Bloomberg. Bloomberg Technology. I'm Taylor Riggs in New York. Now at the C2 Montreal conference, former Apple Senior Vice President of Retail, Angela Ahrendts, spoke to attendees about her role at the tech giant, transforming its retail presence. And I caught up with Ahrendts. We discussed Apple, and I asked her what opportunities she saw at the company that convinced her to join.
One of the main reasons was because I felt Apple was one of the greatest companies on the planet. And I thought through their retail stores, which were so huge that so many customers had come into, that there was absolutely an opportunity to not only take the experience to the next level, but to actually have a greater impact on the communities. You know, Steve's original vision was to enrich lives, and he told the teams to always do it through education. So our goal was really to put programs together that could help reskill the current generation, and and help the next generation learn a lot of the liberal arts skills that I think Steve always envisioned that they would need and his products could provide.
As you reflect back on your tenure there at Apple, what do you consider some of your major successes?
Just as I was saying, I think that we were able to redesign the stores, and there are incredible flagships in the pipeline for the next 4 years. But they're not even stores. We called them town squares or gathering places because the entire community was welcome. And we partnered very closely with cities so that we could put those stores, if you will, in areas that would also help help the city, and be it from Chicago to LA, et cetera. So that was one, but I think the other thing, as we were just talking about, was the in-store experience that we called Today at Apple, and the fact that we were able to completely redefine and redraft some of the roles and create new positions for the teams, and create a whole new zone in the store where they could now educate, come up with all of the Today at Apple programs, and the teams today, over 3,500 creatives around the world, are teaching 18,000 sessions a week so that they can help create the next Apple Music, kids, create the next iOS app developers, help kids be better photographers, better film editors, because again, in the future, leaning into the liberal arts is really, we felt how the next generation is going to earn a living. So all of those free programs were just absolutely huge and very purpose-driven for the community.
You certainly have some major successes, and we always have to ask sort of, what do you wish could have gone better? What do you wish you could have redone or changed during your time there?
You know, funny, I've said this everywhere that I've been. I mean, I never focus on problems because it was my job to fix them, right? And so I can never say that I wish I would have done something else. I always say to myself that I never move fast enough. I mean, I don't think in this day and age, I think technology is just moving everything at such an accelerated rate. So we did a lot in 5 years, but I always challenge myself to move faster and do more.
Well, there were some comments about some of the changes in the retail store, maybe customer satisfaction or employees there maybe not being as technical as they once were. How do you respond to some of those criticisms about the changes in those physical stores?
Yeah, you know, I don't read any of it, and none of it is based on fact. It's everyone trying to find stories, et cetera. You know, when I left, retention rates were at an all-time high, up over 20 points in the 5 years, and NPS scores were at historic highs, and, so again, I know the facts, and so there's a lot of things that are written. You know, I didn't give any stories to anyone because it was, just not how I am. And it's kind of the same thing here today. I'm here for the C2 conference because I love what they're doing. I love that they're helping, inspire large companies, small companies on the importance of innovation and creativity and how you balance that with commercial so that you can have very purpose-driven businesses that make an impact in the future. So that's what I did at Burberry, that's what I did at Apple, and that's why I agreed to come to C2 today to kind of share my thoughts with a wider group.
Well, and when you share your thoughts about C2 and Apple and Burberry, one of the things that you mentioned that was really interesting is it's hard to just move fast enough. As the CEO and leading up major retail operations at some of these brands, what are some of the challenges of being a top leading executive? Is it just part of these big companies can't move fast enough? What would you say are some of the major challenges and learning lessons about being a top executive?
Yeah, I think that, I think absolutely moving fast enough, but I think that, and I think there's a pretty big chasm between, my age, as an executive and my teens, if you will. And, I'm probably not alone in often calling my kids and saying, how do I do this or how do I do this, right? They're digital natives and they see the world differently. What's important to them is very different. So, I think often executives reach a level where, they think they should know and then they surround themselves with similar people. And I think that it's so important to bring in the next generation because they have very different ideas. They see the world very differently. And I don't think that it's, and we tried to do this at Burberry, we tried to do this at Apple. I mean, it is not a top-down exercise running a business anymore. Not in this social age at all. And we ran one of the largest crowdsourcing exercises at Apple the first year I was there, and literally asked 60,000 employees around the world what they felt Apple should be doing more of in their communities. They helped inform the experience that now today is Today at Apple.
Angela, so much of our focus here at Bloomberg has always been on the critical numbers, right? Sales, profit and losses. That's really all it comes down to. We generally have been spoken about a broader slowdown, not only in iPhone sales, but really in the mobile phone market as you're sort of reaching a peak in some of the saturation of the mobile phone market, and people maybe not replacing phones as quickly or as fast enough as they were in previous generations. From your perspective, from the retail experience, how did you work on managing, the revenue coming from the iPhone sales, but also working on selling some of the other brands, the other products that maybe were not the core iPhone sales, that really the core of the company, but also some other products as well?
Yeah, so, I don't know if you know Steve's original vision for retail, and if you listen to Tim at the keynote last September, or the one prior that I did, he would stand up and say that, Apple retail has always been about so much more than just selling. And, they play a huge, they do a disproportionate amount of the service on all of those products. With today at Apple, they do a tremendous amount of education. So over half of the staff is not there to sell. And Steve's original vision was they weren't allowed to sell anyway. None of them are on commission. Their job was to enrich customers' lives and through the lens of education, on the products, on what they could do with them, et cetera. So that was our mission. That was our purpose. There's a lot of things about phone that I had absolutely zero control over, et cetera. I will tell you that the retail stores are the world of. They over-index on almost all products, but there's a very wide distribution on phones.
That was my conversation with Angela Ahrens. Now, Uber is taking its bike rental service to the UK. The ride-hailing giant is rolling out about 350 Jump electric bikes on Friday in the City of London, with plans to add more bikes in the region in the coming months. Uber bought Jump bikes last year for more than $100 million in cash and stock in an attempt to expand its urban transportation services. And coming up, shares of Amazon have jumped more than 20% this year, but one analyst says the stock has much more room to run. We'll have more. This is Bloomberg. And let's get to that market call that gained a lot of attention today. Piper Jaffray says shares of Amazon could hit $3,000 within 2 to 3 years. That's about 65% above where the stock is trading now. Piper says that spinning off the rapidly growing cloud business would help highlight the low valuation placed on Amazon's other units.
If you split Amazon up into 3 major segments, so core retail, AWS, as you mentioned, and then advertising, and then apply something close to a comp group average multiple onto the 2022 estimates for each of those segments, then you basically arrive at a share price of around $3,000 in 2 years, or in mid-2021, if you assume investors are going to be trading the stock off of 2022 estimates at that point.
Still with me is David Kirkpatrick, Techonomy founder, and Bloomberg's Matt Day in Seattle. So Matt, let me start with you. We could talk dividend discount cash flow model all day long. Walk me through sort of the case here to be made for the path to 3,000 for Amazon.
So the case the analyst there is making is actually, in their words, pretty conservative. You assume a bit of deceleration in Amazon's core retail business growth, a little bit of slowdown in their cloud computing growth, but still just projecting a little bit slower growth. They get to a level where they're going to be worth $1.5 trillion here in a couple of years.
So David, talk to me here. What was so interesting about this call is that it was talking about separating Amazon Web Services from the retail. Now, from my perspective, I always thought the two were together because Amazon Web Services was so profitable. Make the case for why you think a separation could happen.
Well, the idea, I think, is to expose the real value of the parts, and AWS is clearly an industry-leading service provider for pretty much the entire economy, and as an independent company would itself be worth hundreds of billions of dollars. The retail business continues to more or less charge toward taking over all of retail in every company in which they operate. I mean, that's sort of the long-term trajectory they seem to be on. And as the analyst said, advertising is sort of the secret weapon that just is slowly gathering strength and really presenting a real challenge to Facebook and Google without many of the concerns about privacy that those services have. So Amazon is beautifully positioned. Jeff Bezos is an incredible operator, and I don't think it's crazy to say the stock could be worth that much.
Matt, let me bring you back in here. What are you hearing in your reporting of what other analysts are saying? This is the first call I've heard where we get to 3,000 by sort of separating off Amazon Web Services. From your reporting, do you hear some of these rumors starting to flicker out there?
Not so much on the separation. It's kind of a parlor game with Amazon. You know, will they or won't they consider spinning off the cloud unit? But I think here more it's an analytical tool for what would they be worth in that case. But I think the call itself is not outlandish at all. I mean, a couple of years ago, stock was trading at $500 a share. Everybody's in the street anyway is pretty pleased with the job Jeff Bezos is doing. They're pretty well beloved for the return they've delivered so far. I'm not sure that this is that outlandish at all, and I think if anything, it's you know, to Piper's point, conservative by some estimates.
So, David, in your note and in your last comment, you talked about sort of regulatory scrutiny, and I found it very interesting that you're right. Companies like Google, companies like Facebook have really been faced harder with criticism from the government. Amazon, for its part, has been able to escape that. It's pretty incredible.
Well, it's incredible because if you just think of sheer scale, Amazon should be included with Facebook and Google as a company to be concerned about. And frankly, I am concerned about their sheer scale. I think it's worrisome for the economy when one company gets the kind of power that they do. On the other hand, everybody loves their Amazon Prime, and you know, there's way less likelihood that the public is going to turn on Amazon than that they would continue to be very critical of Facebook and Google. So, but I also think Jeff Bezos is such a smart guy, and he feels this and knows there is this increasing worry about just the sheer scale of some of these global tech companies. So it could be an interesting way for him to function to deal with that by actually saying, you know what, we will split off AWS and show that we don't need to be, you know, this colossi. We'll be two separate colossi. And, you know, so it would be strategically smart, and it would also do something that would appeal to, I think, a general sentiment in society that, you know, somehow whittling down these companies is a healthy thing in general.
Well, the opposite of shrinking down has been expanding. And Matt, I want to talk to you about another story this week that Amazon was looking into a wearable device that can track human emotions. My gut feeling on this got a little nervous, as someone could be reading my emotions based on the tone of my voice. What is your take on Amazon continuing to expand into all of these other sectors, namely this one could be healthcare, and sort of growing versus shrinking?
I think it's also a reminder, too, of how broad their devices business is, right? We think of them as a retailer and a cloud computing company, but by some measures, they're the third biggest device brand in the United States, with the Echo line of smart speakers, the tablet, the Fire-branded tablets, and, you know, potentially this wearable device, among others that they're considering coming up. You know, they've said they want to take their voice software, Alexa, everywhere, and they seem to be building a device portfolio to try to make that happen. They're also in the process of rolling out a device to sit on your dashboard in your car. So this is definitely a company that has ambitions to be in the hardware business as well.
Well, we will be eyeing that road to 3,000. Thank you. That was David Kirkpatrick, Techonomy founder, and Bloomberg's Matt Day. And coming up, we head back to 1962 when television was first introduced. How the technological platform became global next. This is Bloomberg. According to the Wall Street Journal, Snap is in talks with major record labels to broaden out ways users can add music to posts on its app. Snap is seeking broad rights to catalogs of Universal Music Group, Sony Music Entertainment, and Warner Music Group. The licenses wouldn't allow Snap to make on-demand music service such as Spotify and Apple. And the dawn of worldwide live television can be traced back to July 10th, 1962. That's when AT&T's Telstar satellite successfully transmitted a signal between the U.S. and Europe for the first time in history. Let's take a look at that history.
One small step for man, one giant leap for mankind.
Many of history's most iconic moments have something in common. They were broadcast to the world live by satellite. But this technical feat that we take for granted was not even possible all that long ago. In fact, the entire era can be traced back to July 10, 1962. the day TV went global.
And here it is, television.
The exciting new medium of television had been in regular use since the 1940s. But there was a problem. Live TV could only be transmitted by cables or by terrestrial repeaters, and both methods were impractical over very long distances. In the first half of the 20th century, a radical idea had been proposed in scientific circles. What if an object could be put into outer space that would act like a giant mirror, bouncing signals from one point on Earth to another? At the time, no man-made object had actually been in space, but technically it seemed possible. In the late 1950s, hundreds of engineers and scientists at AT&T Bell Laboratories were put to work on an ambitious new project.
The first active communication satellite in space.
The project was called Telstar. By today's standards, the design was rudimentary and consumed less power than the average modern laptop. But at the time, it was cutting edge, featuring then new technology such as solar cells, transistors, and a telemetry system for collecting data. No less impressive was the ground equipment needed to track, transmit, and receive signals from the Telstar satellite. Massive yet exceptionally precise satellite dishes were constructed on both sides of the Atlantic Ocean in order to capture and amplify Telstar's faint signal as it whizzed and bobbed through its elliptical orbit. In the early morning of July 10, 1962, Telstar 1 was launched atop a Thor Delta rocket from Cape Canaveral Air Force Station in Florida, the same site from which the Apollo 11 astronauts would depart for their trip to the moon almost exactly 7 years later, a feat that would be broadcast live to the entire world, thanks in part to Telstar's groundbreaking achievement.
Armstrong is on the moon, Neil Armstrong.
Around 15 hours after its launch, Telstar relayed the first live satellite video transmission in history, a congratulatory telephone call between U.S. Vice President Lyndon Johnson and the chairman of AT&T, which had funded the project.
Good evening, Mr. Vice President. How do you hear me?
You're coming through nicely, Mr. Capel.
Well, that's wonderful. The first telephone message in the world over an active satellite.
2 weeks later, on July 23rd, a 20-minute multinational program was broadcast to hundreds of millions of viewers in Europe and the Americas.
Good afternoon, and soon we'll be saying good evening to Europe on the first exchange of live programs between the television networks of the United States and their affiliated stations and the European Broadcasting Union.
The lineup included a brief glimpse of a baseball game at Wrigley Field.
Let's give all the baseball fans in Europe a big hello from Chicago.
Remarks by U.S. President John F. Kennedy.
I understand that part of today's press conference is being relayed by the Telstar communications satellite, and this is another indication of the extraordinary world in which we live.
And live scenes from landmarks around the U.S. and Europe. A new era had officially dawned.
Putting another bit of history behind it, Telstar will now rest for 2.5 hours while its solar batteries build up energy for another epoch.
Telstar was celebrated as a monumental achievement and became a sort of high-tech celebrity, praised by politicians, journalists, and scientists, and referenced widely in popular culture.
That's no moon. It's a space station.
Live by satellite soon became a regular feature on network television for everything from breaking news.
Mr. Gorbachev, tear down this wall.
To sporting events. With the ever-present shadow of the Cold War looming large, Telstar also marked a rare early victory in the space race for the United States, which by that point had been beaten by the Soviet Union with the first satellite in space, the first animal in space, and the first man in space. Unfortunately, the first Telstar satellite was damaged by residual radiation from a thermonuclear bomb test the day before its launch, which led to the satellite's early demise within a few months. Nevertheless, it demonstrated to the world that live communication via satellite was feasible, proving the concepts laid out by early visionaries. Soon to follow were more advanced communication satellites, such as the Hughes Syncom, whose much higher geosynchronous orbit allowed for true 24/7 global TV coverage, far beyond Telstar's limited broadcast window due to its orbit path. Although Telstar's technology was soon eclipsed, the project also marked another important first. The first privately sponsored space mission carrying a commercial payload, at a cost to AT&T of about $25 million per launch in today's money. Despite early concerns by policymakers about the potential domination over space communications by private industry, the success of the Telstar project and the urgency to compete against the Soviet Union helped to usher in an age of competitive cooperation between the U.S. government and the private sector in developing space technology. That continues to today with companies like SpaceX, Blue Origin, Virgin Galactic, OneWeb, and countless other startups. Thanks to the new commercial space race, satellites have once again become the center of attention. The cost to build and launch new satellites continues to drop, widening the playing field for eager entrepreneurs such as Elon Musk and Jeff Bezos, who are developing satellite networks to provide broadband internet to the estimated 4 billion people who lack reliable access. Other new satellite projects are devoted to everything from tracking greenhouse gas emissions, to urban traffic flows, to refugee movements. Thousands of satellites are currently in orbit, with thousands more likely on their way in the near future. SpaceX alone has filed for FCC permits for almost 12,000 new satellites in coming years. Meanwhile, almost 60 years later, the long-dormant Telstar 1 is still floating around our planet, a celestial artifact from a moment in history that launched the world as we see it today.
That does it for this edition of Bloomberg Technology. We're off for Memorial Day holiday in the U.S., but we will be back on Tuesday. And remember, we're live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg.